domestic currency. Now, this is also the first such directive from the central bank in nearly 15 years, underlining the urgency of this situation. To discuss more about this particular aspect and how it impacts not just rupee economy as well as the bank profitability, we are joined by a whole host of experts right here. Let me welcome on the show Dinesh Khara, former chairman, State Bank of India, Amit Pabari, who's the managing director, CR Forex Advisors, Kunal Sodhani, who's the head of treasury at Shinhan Bank, and we also have with us Teresa John, who's the deputy head of research and lead economist Nirmal Bang. But before we head to our guest, let's also understand this particular matter. If we have our colleague who will be joining us to really explain what this move really means. So Amit Pabari, as a forex expert, how do you see the transactions and how much of the year-end transaction pressure and account settlement pressure has also come into the mix to put pressure on the rupee?
I think the kind of move what RBI have taken is fantastic. They have taken a move called Dhurandhar kind of a move, or telling to the market that main hoon na. So basically, in the short term, it is definitely a positive step, and because of which we are expecting we can get some amount of appreciation in the dollar rupee pair. Saying that the overall trend will depend on geopolitical tension. If the geopolitical tension persists, oil continues to go higher, FII will continue to take out money, and trade deficit will increase. So structurally, these are the major things which is going to put pressure on the rupee. But in the short term, we can expect rupee to get stronger towards 93.5 kind of a level, and any dips will be bought by importer, because structurally, till the time issues are there, importer will go and buy, and probably exporter will stay light on the hedging side.
Right. Amit, thanks so much for putting that into perspective. But let's just getting too high and overall impact on the economy as well. But Amit, when we talk about this ceiling coming into effect, what are the other aspects which get impacted besides also averting the rupee fall? Do you think that the volatility is going to increase because of the semantics and the movement and the offshore overbearing nature on rupee's movement?
Definitely, after 10th of April, as the banks have been limited to operate, we can see a lot of volatility, and offshore market is again going to determine the value of rupee on the onshore. Before 2020, that was the case. That is why RBI bought this regulation. As again they have moved back to the old regulation, we are expecting volatility is going to go up. Second, gap up, gap down chances will increase. Third, hedging cost across the tenure is going to increase. So in the long term, it is a negative aspect. In the short term, it is going to support the rupee. But the idea is that when the things were good, RBI allowed banks to go and hedge or take a position in the offshore. When the things are difficult, they have come back and said, let me protect the situation currently and take a collective action so that speculation position do not build up. My sense is that they are going to come up with many more steps like that to curtail the volatility. So it's a situation where you trade off. What is more important? Whether it is important to curb the volatility at this point of time, or whether it is important to look into bank's profit at this point of time, or whether you want to increase the hedging cost. So RBI have taken a bold step stating that currently I want to reduce the volatility, and I am not going to allow rupee to weaken drastically what has happened in 2008, 2013 kind of a scenario.
Right. But Amit, one quick question to you as the Forex movement, how do you see the rupee really averting further fall? Because today we saw enough amount of volatility, but the market pressure is really weighing heavy despite RBI's new mandate coming in for the banks. How do you see in the next few days rupee movement from your channel checks and from the trading perspective?
what we are suggesting to our clients is that between 94.5 to 95.20 kind of a level, they should participate and increase their hedge ratio. The entire theme is that if RBI is very clear, they want to protect the overall rupee weakness. So there are high chances the rupee might get stronger and move towards 93.5 kind of a level. And if the war gets stopped, probably we can see 93 or 92.80 kind of a level. So basically, if the entire move from 90 to 95 has happened, so now 95 is going to act as a very, very strong resistance, and probably this is the best time where an exporter should increase the hedge ratio, an importer should stay put probably towards 93.50 or 93 kind of a level. They should start getting longer. So the idea is do not get panic on the buying side, get activate on the selling side. Technically, equity markets are at bottom. FII exited the market when rupee was at 83. So now rupee is at 95. So probably, once things get settled down, we might see good amount of interest coming from the FII side also. So FII coming back, war getting stopped, crude oil price getting lower,
Yes.
RBI protecting, these are all positive
All
impacts
right,
can happen.
and that is also utopian to think of right now, Amit, but I like your confidence and positivity on this. But we have tried to cover all corners at this particular point, and yes, rupee has recovered because of RBI's action. The market pressure, FII pressure still remains. Thank you so much, gentlemen, lady, for joining us on this discussion with all your perspectives. Thank you, Dinesh Khara, Teresa John, Amit Pabari, as well as Kunal Sudhani for joining in.